Where are we today? About the lowest point ever in the history of the United States in terms of interest rates. You know, we have, I think most of us got used to this period of very average interest rates that started basically in the post-war period. Before that, through the gold standard, lower interest rate, but certainly more hovering, also with much lower inflation, by the way. Now today we are in a level which is completely, you know, odd and, you know, an outlier by historical standards. You know, insurance companies basically reaching out for yield, sort of getting a more and more getting into more riskier and riskier bond, all to try to make the 5% spending ratio that is typical of these institutions in a world where, you know, standard asset classes are not, you know, that not going to give you that easily. You know, one implication I'm going to discuss today is that has also led to an enormous increase in being aware of what costs and performance really mean in the asset management industry. When, you know, treasuries are paying 8%, what does it mean 50 bp or 100% bp management fee? When interest rates are zero, then you start thinking, oh, wow, 100%, 100 bips, I mean minus 1%. So I need to think about that. And that is changing the industry quite a bit, and it's changing it in my view. And the other thing that is becoming very important is you need to adjust to expectations of returns, but now you need to be much more aware of what risk management really means. And you know, when net return is in the low single digits, justifying very high fees is extremely hard to do. So, you know, fees are becoming front and center, and they are becoming front and center for all type of investors, at least in the US, but I see this happening everywhere. Throughout the growth of, you know, the golden age of hedge funds, which is, you know, mostly late 90s all the way to basically 2000, you know, the crisis, basically. Alpha just kept going up and accumulating, you know, all the way to, you know, a peak of accumulated alpha of about, you know, 130, 35%. Since 2011, basically, the accumulated alpha has been on net negative for hedge funds. You know, we have been living for now, I think 15, 20 years in an environment with very low real interest rates, low risk premia. That's creating a lot of havoc in the industry, transforming it. The changes in technology, like Per, you were mentioning, etc., is actually changing the industry in many ways. Lower fees, the growth of quant versus fundamental, the growth of activism. I think these are very big trends in the markets that are really changing the way we invest as institutional investors and the way that we are managers of assets. We need to think about how to compete in this world. It is much tougher today than it used to be in 1999.